Hello and welcome to this brand new video. Today we look at the results of our June Strategy of the Month contest. We will see which strategy won and a selection of the best among the entries we received. We'll also try and provide trading insights by analysing the logic of these strategies, in which markets they work and how they perform. We'd like to remind you that the Strategy of the Month contest is reserved for Unger Academy students. Each month, they can participate by submitting their strategy and competing for a chance to win a €1,000 Amazon gift card. One of the coaches of the Unger Academy here, and as always, before we begin, I invite you to please subscribe to our channel if you've not already done so. And if these insights are useful, also leave us a like in this video. Now let's get right into the first strategy that I'd like to show you today. This is a strategy on the VIX futures. The VIX futures is an excellent instrument for those who want to trade volatility, and one of the best performing tactics is to go short precisely when this instrument is rising slightly. This index is famous for having a mean reverting behaviour, and indeed this strategy is based on exactly this logic. That is, we sell a contract on the VIX futures at the highs. This is an overnight strategy, which means that positions are left open for multiple sessions and then they are closed either upon reaching a profit target or through a break-even or a stop-loss. So the new trades will be opened near the highs of the previous session. Let's look at a typical case such as this one. You can see that we sell the contract around the highs and then manage the position by closing it through a take profit, a break-even or a stop-loss. Let's look at the performance report of this system, which has been very consistent over time. We have an average trade of almost $280, excluding slippage and commissions. I want to point out that commissions are in the $2 to $3 per contract range, so they are minimal. On the other hand, slippage could cause a lot of problems with this contract. In fact, each tick, in other words, the smallest movement of this future, is worth $50. This means that one tick of slippage is $50. So having one tick of slippage when we enter and one when we exit a position would result in a $100 deduction on the average trade. So let's go through a quick exercise and add the costs. This is an exercise that we show very little of, but I want to show it to you today. We enter our slippage in a straightforward way by contract, and we get a result similar to this. $230. As you can see, the average trade has decreased very little and not by $100. This is because we are working with limit orders. Namely, we set ourselves to wait until the price has risen to the point where it reaches the high of the previous level, and then we sell. Therefore, we will never enter using market type orders, which means that the strategy can only suffer slippage with stop loss. And we see very few because the average trade decreases very little. As I said, this strategy shows excellent performance. Let's look at it year by year as well. Even considering slippage costs, we only have one losing year. I guarantee these numbers will stay more or less the same if you also consider the commission costs. The second strategy I want to show you, which is no less important, is the strategy on the Nasdaq, which is the index futures of the 100 highest capitalized US tech stocks. This system works differently than the previous one. It provides orders executed when a specific condition, a particular price pattern, occurs, and it divides the operation sharply between long and short based on a moving average. If we are above a specific moving average calculated based on a 60-minute time frame, we will trade long, meaning we will buy the contract. On the other hand, if we are below that moving average, we will sell. So we don't trade at the crossing of the moving averages, which is a very common approach, but we only trade when specific price patterns occur and at the position of the price relative to a specific moving average. Again, we will manage the exits using a take profit and a stop loss. Unlike in the previous case, the strategy doesn't have a break-even stop. Let's get straight to the performance. This system performed very well, especially in the last period. It didn't do much in the early years, but I remember that over the past years, this market responded rather poorly to this tactic. Let's say from 2006, 2008 through to 2016. And it only makes sense to look at this system as part of a specific date, due both to its specific nature and the characteristics that this strategy exploits. Let's look at the metrics as well. We have a substantial average trade well distributed between the long and the short sides. Let's go and have a look at the equity lines as well. The short part you see isn't responding. Actually, not at all until 2016. There's a reason, as we said. The equity long part is very promising. Let's also go here to look at the annual gains as well. 2023 is one of the better years. In only 6 months, it has already brought in more than $60,000 in profits. The best year ever is 2020 with over $120,000. This year it might have been a bit difficult to trade all the year because of the big crash that took place in March, which caused some difficulties in trading the markets. So we definitely would not have taken all the profit because we would have been out of the market given the high turbulence. However, we would have certainly taken home quite a bit from this particular problematic year as well. Finally, let's look at the winning strategy that won the €1,000 Amazon gift card for June. This is a strategy for gold futures. Not a multi-day strategy like the last one, but an intraday strategy. So we will close all positions at the end of the session. It's a very simple breakout strategy that follows the bullish or bearish movements of the market. The entry orders are based on the breakout of a Donchian channel. The Donchian channel has already been illustrated in many of our videos, which we invite you to have a look at. Put in simple terms, the Donchian channel is a channel formed by price highs and lows within a specific range. For example, we see a long entry on peaks near this area and then the trade is closed at the end of the day. Let's take a look at the performance. Again, they are very consistent and well distributed between the long and the short sides. We have a total of 1,500 trades, so it's an outstanding number statistically speaking. The average trade is not particularly large, as with the systems mentioned above, but that's simply because of the nature of the system. This is an intraday strategy where we stay in the market for a shorter time, so we should expect a smaller average trade. But let's also take a look at the periodic returns. If we don't consider costs, all the years are positive. Considering the costs we would incur by trading this type of strategy, we see that 2017 would certainly go into a nice loss, since it only did 87 trades. But all other years should more or less hold up. The year 2023 doesn't perform as well as the previous years, but still, this system shows excellent robustness. I assure you that the analysis we have done to accurately test this system has shown that it is based on a very robust logic. And if your goal is to learn how to independently create trading systems like the one we've just seen, then you've come to the right place. While you are learning, you can also enter this contest dedicated exclusively to Unger Academy students for a chance to win a €1,000 Amazon gift card each month. So if you are interested, click on the link below, which will take you to a page where you can find both the contest rules and, if you like, book a free consultation with one of the tutors, who will give you all the information you need. Finally, if you haven't already, please subscribe to the channel and leave us a like if you're interested in these trading insights. I'll see you in the next video with more insights and ideas on systematic trading. Until then, goodbye.